Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really glad to have with me once again my friend, Michael Oliver. Welcome, Michael, and thanks for joining me again.
I'm glad to be back.
Always good to talk to you. Before we begin our discussion, let me just remind my listeners that in order to follow Michael's work and to learn more about it and learn how they can partake of it on a more regular basis than just once in a while on this, well, we usually try to get Michael every week if we can, but every other week or so he's here. But to partake of his many missives that he sends out on many different markets, go to olivermsa.com. There you can learn how you can partake of his wisdom. And Michael's been around, has done a great job for many years, and now is sharing some of his wisdom and insights with us. So I want to ask you, Michael, you put out this morning a very interesting report titled Watch Base Metal Sector for Signs of End to Commodity Deflation, and you cited two major mining company stocks in particular to keep your eyes on. Those two were Rio Tinto and BHP Billiton. What is the price and momentum action telling you about those two stocks, and what might it mean in terms of a turn for the metals?
Well, the reason to watch those two stocks, aside from their huge size, is that they were the poster child stocks of the collapsing metals markets. Gold miners as well, but these two in particular are huge companies, great impact, and their stocks just keep collapsing and collapsing over the last few years. In June, I did a report on them just to see if there was a potential. They were trying to bottom at that point. There was a horizontal price action and so forth, and I said, nah, they're not ready. And they broke hard since June, another leg down. But now the action in both stocks, especially momentum, not so much evident on price, because price usually does not tip you off until, it's come up out of the hole. But the momentum action clearly states to me, now we're in bottoming posture now. Now, they're not broken out. I wouldn't buy them right now. But not far above each market. They're in the mid to upper 30s each dollar price. Just above 40, basically. Both of them engage some stuff that looks really good if it happens this quarter, if they close a month up there. Next quarter, which might be more opportune time, the same breakout number drops into the 38 level. So basically, if they just stand still between now and first quarter of next year, they're in a position to break out. And they look like once they break out, they could be bottle rocket situations, meaning that they've been beat up so badly, so far off the page, that markets like that get overshot on the downside, much like blow-off markets do on the upside. So the first turn is often, a void because you're sold out. And therefore, I think if those poster children of the, quote, deflationary collapse in commodities are ready to turn, that says something.
What sets these things off, Michael? Sometimes short selling or what?
Well, obviously in the tail end of a bear market, the shorts are all over the thing because that's, the trend is your friend, and just like on the upside, the longs are deeply entrenched near tops. And the same on the downside. And the shorts, just like the longs on the upside, think it's going to go forever. Well, it isn't unless they're going out of business, which is highly unlikely. So the turn is largely sponsored by short covering and the absence of sellers. So when the shorts go in to buy, there's no ready offers. Why? Because everybody who wanted to sell it is already sold.
Yeah.
So that's why you end up with these phenomena like a beach ball coming up out of the water. You need to push it under the water and then let go of it. Whoosh, So I'm watching those, not so much to participate in them, but it's just a good solid clue that the popular deflation in commodity trend that everybody's so obsessed with is really wrapping itself up. Most commodities got beat up well before oil did and have paid their dues, have showed evident basing action or upturns. And the laggards like oil and these steel producers, iron ore producers, they're laggards. And so when they turn, I think it's sort of like those are the last guys. And it will be a very solid sign that, okay, that argument, that case of the deflationary scenario for commodities is ending. Now, that doesn't mean there won't be deflation, but I don't think it's going to be in commodities anymore. I suspect it's going to shift to the equity markets.
Well, we've certainly had massive price declines in oil and in the metals for sure, as you point out, and it does seem to be some bottoming there. Looking at your charts and others that I've looked at, but broader implications for this, Michael, in terms of what it might mean for some of the other markets?
Well, Well, I think it's an asset class shift on the part of the investor. Investors they're not fickle. They tend to get married to something for a while, but they never get married to a market for more than 4, 5, 6 years. And then there's a change, and usually the smart money, leaves the upside in a market that it's too long, and the tooth starts to wobble around. The smart money starts to evacuate. Market starts to crumble. Then more and more people leave. Well, they go somewhere else. And certainly the central banks have provided plenty of liquidity. And it went into the equity markets for the last several years, but that liquidity can easily shift over to the commodities. Once commodities are perceived first by the smart money as, one, having ceased in their decline, and two, as having based and turned up. The public won't recognize that, and most asset managers won't until probably well after the low. But this has happened many times in the last 30 years, as you and I know. It happened in the 70s, it happened in 2000, it happened, many pivotal times when public perception of cheapness and expensiveness changed. And when it changes for several years. It doesn't change for a few weeks. So this is issues.
Yeah, and the good thing is that you seem to be able to get out ahead and anticipate these turns well in advance of them happening. And just like you said today, don't go buy these things yet, but get ready and keep an eye on them. And when they break through, that's what I love about your service. It gives a good heads up. With just about 2 minutes left, Michael, let me ask you. Normally, when we think in terms of higher metals prices, higher commodity prices, we're thinking of a weaker dollar. What are you seeing in the dollar now? Are you seeing a possible turn there as well?
Yes, I think I am. It's first of the context. MSA forecasted a big bull trend in the dollar back in 2011 and 12, and actually forecasted that it would reach 100 on the dollar index. It reached 100 in March of this year, 100.30 something, and is now in the 95, 94 level. I think if you drop back to 93, we've had a low for the year around just below 93. This is, again, the cash dollar index, which is trade-weighted as the euro and the yen. If you go back to 93 again, and we've been in the high 93s last week, I think, if you touch 93 again, I think you're in trouble, and I think the dollar could slip under 90, go back into the 80s. It's about as far as I could see right now. But in my opinion, if that happens, you've seen the high. Now, that doesn't mean you're going to fall apart in the dollar, but it means that high at 100 was it. Circle it. And the dollar will then join the other currencies, because I think our central bank realizes that one game they've not played, they played the QE to the hilt, is the foreign exchange game. Let's get our currency down to help our industrial companies. Well, they've not focused on the dollar, and I think in the last Fed minutes, I've seen some online-type data points that show that the mention of the dollar in recent Fed minutes has gone off the page. There's so much chatting about the dollar in the Fed minutes. I think they're turning attention to that instrument, that right. issue of getting the dollar down to help, quote, the manufacturing companies, which are really weak.
Yeah, the multinationals are big, and they're being hurt. Well, my engineer is telling us we're basically out of time here, Michael. I want to thank you very much for being with us again. And folks, it's MSA. It's OliverMSA.com, OliverMSA, to follow Michael's work and to learn how you can partake of it. Thank you very much, Michael.
Thank you, Jay.
For being with us again, and look forward to it next week.